right. So, welcome. Thank you guys for joining us today. We're happy to have Jan Valeka here to talk about credit and debt. Please post any questions you have in the chat and we'll get to them at the end of the program. So, let me introduce Jan. She is the owner of Valeka Wealth Management, a boutique wealth and investment management firm. Her career began at Morgan Stanley, and after 17 years at a major wirehouse and obtaining the Certified Financial Planner designation, she founded Valeka Wealth Management. Becoming independent gave her the opportunity to offer comprehensive planning, financial planning, objective investment advice, and customized strategies to her clients. She provides honest feedback on her clients' personal situations that they would not get online or from the various trade publications or TV shows. As an industry veteran since 1988, she has had the opportunity to guide investors over the last 3 decades. Her mission is to help you simplify your financial life with planning. So, Jan, welcome. We're glad to have you back. I'm going to turn it over to you, and then I'll come back at the end for questions. You're muted. Do I?
Thank you, Jennifer. Thanks for the introduction. I'm really excited about presenting this. Let me come online so I can share my screen. Okay. There we go. Is everything good? I'm really excited that Fort Worth Library asked me to present this today. We're going to be talking today about credit. The untold story. And I was talking to Jennifer, it's a little bit of a game. So I hope that you're going to get some tidbits from this information today and learn what credit is and what is debt. And then also how to build and maintain a credit score, which is called your FICO. So credit can be the best of times and the worst of times. It depends on if you're on the right side of credit or if you're on the bad side of credit. Why is good credit important? Employers are increasingly checking credit scores to make sure that they are going to get good prospective employees. Landlords check your credit score because they want tenants that will pay their bills on time. Mortgage and credit card lenders want borrowers who will pay them back. And credit cards can make renting a car, hotel reservations, and shopping online much easier. Believe it or not, your credit score even affects the rate you pay for your auto and homeowners. What is a credit report? Who's looked at their credit report in this group? I hope that you have, because we'll go over some information where you can get a free credit report. But what we're going to talk about right now is what goes into your credit report. It has 4 parts of your personal identifying information. It has your name, your social security number, current and previous addresses, telephone numbers, birth date, current and previous employers and spouses' names if married. The second part is your credit history, which is the account record with different credit, which is your account record with different creditors. It shows how much credit you've had and how you've repaid it. The third section is inquiries. Inquiries show when creditors request your credit report. Too many hard inquiries can hurt your overall credit score because they indicate that you're looking for more credit. Hard inquiries are the ones that count. Those are the ones that when you give a lender permission to look into your credit history. Soft inquiries don't count, and they're the ones where you're looking at your own score. The fourth and last section is the public records. Public records includes collection accounts, bankruptcies, foreclosures, tax liens, civil judgments, civil judgments, delinquencies. I'm sorry, I went a little bit too fast. Student loan payments. What's not in your credit report? There's a long list of what's in your credit report. There's many things that you might think would be included, but are not. This includes checking and saving balances, any income that you receive. Your medical history is not in your credit report. Purchases made with cash or check, because they're not credit. You're paying with cash. Also not included is any business account information, or your race, gender, religion, or national origin, not even your driving record. So how do you get a credit report? You can get one free credit report from each of these 3 national credit reporting agencies once a year. You go to www.annualcreditreport.com, or you can call a toll-free number, which is 877-322-8228. Reports from the 3 agencies can be spread out over the year so that you can monitor your credit every 4 months. So if you put a reminder in your calendar for the date and the agency. So in other words, between the 3 credit rating agencies, you can rotate. There's some reasons you might get a free credit report beyond once a year. If you've been denied credit, insurance, or employment as a result of your credit report, if you believe identity fraud has been resulted in inaccuracies in your report, if you'll be applying for unemployment, if you're receiving welfare or assistance, and if you've been denied credit, you have the right to a free credit report. Chapter 3 in our story is your credit score. This is really important because we all hear about FICO scores. Your credit score is a numerical reflection of your credit report. So a lot of us has finished schools, but we're still having these report cards, and it's a report card on your credit and your worthiness of paying back credit. One of the most widely known scores is your FICO score. A FICO score is a summary of the information in your credit reports. It represents your potential credit risk. A high score means that you're at a lower credit risk and you'll probably be approved at better rates. If you have a low score, don't worry. You could be approved, but with less attractive interest rates, or you could be declined altogether. So we're going to talk about what's in a credit score and how you can kind of play the game to increase your credit score. FICO scores range from 300 to 850. The vast majority of the US population scores between 500 and 799. It's very uncommon to have a credit score over 800. Anything over 750 is considered an excellent score. What makes up your FICO score? I put a list here of the 5 components. We're going to go over them each by each, but this is your FICO score, and then what your FICO score means to lenders. 800 to 900 is exceptional. 740 to 800 is very good. 670 to 739 is good. 580 to 699 is fair. And 250 to 579, a credit lender would consider you risky. And so they're probably not going to give you the best rates on your credit cards. What's included in the FICO score? Well, we know that we would question, is it gender, race, marital status? No, it's not. None of these. We might wish some of these were in our score, but since none of these are included in your credit score, they're not in your report, they're not reflected in your score. What's really in your credit score? The exact FICO scoring formula is a closely guarded secret. We're going to break it down today, but they do provide some guidance on what's important and how much weight is given to each. Let's look at these numbers a little bit more closely. 35% of your score, so this is the most important, is based on your payment history. How many bills you've been paid that you've paid late, how many were sent out for collection in any bankruptcies. The more recent, the worse it will be for your overall credit score. 30% of your score is based on outstanding debt. The more cards you have at their limit, the lower your credit score will be. So the rule of thumb is to keep your credit card balances at 25 to 30% of your limits. So I put an example here. Let's say that you have one credit card and you have a $5,000 credit limit. When you open your bill, it's going to tell you the amount of credit that you have. But if you have a $5,000 credit limit, and if you're trying to stay within under 25%, you should not put more than $1,250 on that card and try to pay it off monthly. If all of a sudden you have a balance of $2,500 on your card that has a $5,000 limit, that's going to mean that you're utilizing 50% of the credit. That goes into the calculation of your credit score. And that's a pretty big calculation. It's the second largest, which is 30% of your score is on your outstanding debt towards your credit. 15% of the score is based on the length of time you've had credit. For creditors, information about your past payment history helps them get a prediction of your future actions. The longer you've had established credit, the better your overall credit score will be. The trick here is do not close your accounts after you've paid them off. I was telling Jennifer early, this was really one of my first introductions. I had my first credit card that I'd had forever. I had paid it off. I thought I did a really good thing, and then I just put it away. I hadn't been using it. And then all of a sudden, I got a notice years later that they were shutting this credit card down. I didn't want them to. I didn't ask them to. But the length of time had gone by that I had never used it, and they just took it upon themselves to close it. That actually hurt my credit score. So even if you pay off a credit card, what I suggest people do is get a baggie, get a file, keep these credit cards, and then maybe pick 1 month out of the year where you put just a little bit on that card and then pay it off. But do not let it go so long that you never use it and then they choose to shut it down. That will actually hurt your credit score. 10% of your score is based on new credit. So opening a new credit card will negatively affect your score for a short time. You get a little bit of a break because the score interprets several hard inquiries within a month or so, or just one inquiry, to account for the way people shop around for the best deals on loans. So if you're all of a sudden you're shopping, for a home mortgage or a loan, and you have several people looking at that, that's within a month. It's not going to hurt as bad. But 10% of the score is based on your credit mix. So it will help with your score to show that you've had experience with several different kinds of credit. Did you know that there's different kinds of credits and they're scored and looked at differently? So for example, when you get a home mortgage, that's that's a installment loan. Or if you get a car payment, that's an installment loan. Revolving credit are things like credit cards. So those are the different mix, revolving and installment loans. You can order your credit score directly from myfico.com. Some credit card companies provide you with FICO scores monthly for free on your statements. I know that Discover does that for me. So every month on my statement, it shows me my current FICO score. Citibank provides the same. And so they'll let you know if the credit score has gone up or down. But it's really important that you keep an eye on your credit score and that you monitor it. You can also get your credit score for free from any of the agencies when you order your credit report. Can you get your score for free from Credit Karma, Credit Sesame, or Quizzle? You can, but they're not exactly equivalent to the FICO scores, but they may be helpful in checking your score over time. I would say if you have a credit card that provides it for free, I would stick with that instead of giving your information to an outside entity like a Credit Karma. How can I improve my credit score? There's several important things that you can do to improve your credit score. They'll take time before you start. You need good credit. First, don't close old credit cards. That was my lesson. It really hurt my score. So, if you pay off a credit card, you think you have done a good thing, so that's okay. But don't shred that card and rip it up. Keep it where you can access it again. Longer credit histories are generally better, so it actually goes towards helping your score. It might be a card that had a real high interest rate, so I get it that you don't want to use it, but you could still do a $10 charge and then pay it off at the end, at the end of the month. And then that would keep your card open and the credit accessible to you, the credit available. Pay your bills on time, month after month, year after year. The older delinquencies become less important to your score. So if you have new credit, be sure that you're paying that on time. Get current on your bills. Remember that the largest part of the credit score is 35% is timely payment of bills. Keep balances low on your credit cards. We talked about this earlier. You're in good shape if you use less than 30% of your available credit. So distribute your charges so that no one card is over 30%. Example, a card with a $5,000 credit limit, you would not want to go over $1,500 on your balance. $2,500 would be using 50% of your available balance. Pay down outstanding debt rather than moving the balances around between cards. That will help you get below the 30% ratio. Don't shop for or open new cards or loans that you don't absolutely need. Applying for credit creates an inquiry. Remember, that's a hard inquiry. And too many inquiries can actually lower your credit score. If you find wrong information on your credit report, report it quickly. Each reporting agency can have different information. That's why it's good that you need to obtain three from the different credit reporting agencies and check for accuracy. I have my FICO. That's the official number, right? Actually, the credit websites use different FICO scores. There's actually 49 different FICO scores to determine how risky you are as a to lend to. So there's no credit rating magic. The best thing that you can do is what you're doing right now, which is listening to information, learning more. And when you apply for a credit card, FICO has a credit score that lenders can use. There's a FICO mortgage score. There's a generic FICO score. There's even one for auto loans. And so the lenders have a different way of looking at, if you're a credible risk and setting the rates. What you should consider when you're comparing credit card offers is APR, that's the annual percentage rate. A lot of credit cards are charging large or higher rates now. Your periodic rate is the interest rate used to figure the finance charge on your balance. And then your annual fee. Some cards have an annual fee and some don't. So take that in consideration when you're looking at cards. A few more things to consider. The grace period. It's the number of days you have to pay your bill before the finance charge begins to add up. Finance charges. Most lenders calculate finance charges using an average daily account balance. And then other fees. Many cards might charge you a fee when you get a cash advance. That's really a large fee and a high interest rate, so try not to do that. And late payment charges. If you go over your credit limit, or if you pay your bill late, they'll charge a pretty hefty fee. Sometimes it's $35, sometimes it's $50, so you need to pay attention to that. This is an important slide. People ask me all the time, what about store charge cards? I've had this happen to me. You're shopping at Kohl's, or the Gap. They offer you, if you take their in-store promotion, you get discounts, you get a discount on this particular purchase. It's tempting, I know. And they can help build your credit score if you need to get started. However, they can have high interest rates that quickly wipe out any promotional savings. They can have low credit limits. And so you can open the card, but it might be a $500 credit limit. You've had a hard inquiry. And the hard inquiries can lower your credit score. So with all those promotions that can really wipe out, advance. It can really wipe out what you're trying to do with advancing your credit score. So when you're shopping, it's back to school, it's tempting, but I would say if you already have some credit cards in your name, try to skip those promotions and say no, and think about if you're doing that, that's a hard inquiry. So by now we're halfway through and you're saying, I wished I'd have known this 10 years ago. Even if your credit is circling the drain, there's a lot of things that you can do to rehabilitate it. Write down your budget, including all of your debts. So right today, after you finish the seminar, take out a pen and paper and write down your budget. Prioritize things you need, which is housing, food, utilities, clothes, and transportation. And then work with your creditors to develop a repayment plan that fits your budget. You're going to start with your secured debt, which is your house and your car, and your government debts. Next comes the unsecured, but the things that you're motivated to pay. This is usually your most recent debt. You know, if you've realized from what we were talking about, that really hurts your credit score. So you want to be paying those credit cards that have recently been opened. And you want to pay attention to the debt origination date. They will drop off after 7 years. So if you have old credit cards that you're late on and it's near the 7-year mark, don't communicate with that old debt, because that will restart the clock on looking at your, updating to your credit score. What are the factors that go into the highest scores? Age of accounts, we've talked about that. The oldest revolving account is your credit card. For the highest achievers, it's about, for the people that have really high credit scores, the average age is 19 years. And the average age for all their accounts is between 6 and 12 years. So they have credit cards that they've maintained and paid off balances for a long time. They have no bad debt. And the number of accounts, credit cards that they have, what is that magic mix? According to a post by my FICO moderator, 6 accounts is the average for high achievers, that with an average of 4 to 5 credit cards on file. They try not to go over that. And your mix of credit, we talked about that. It used to be that you could obtain a good credit score with just loans or credit cards, but the formula was changed a few years ago. If you want to get to over an 800 credit score nowadays, you have to have a good mix of different credit accounts. Revolving accounts, this is credit cards. That would be the store cards too, so any kind of credit card. And then installment accounts. Installment accounts are loans where you pay a fixed amount each month. Think mortgage, car, etc. Payment history. High scores have perfect payment histories. So depending on the source of your reference, having even just one 30-day late payment reportedly may knock your score down by 60 to 120 points. The higher your score, the greater the fall. So do not be late on your credit card payments. Even if all you can afford is the minimum, make sure that that minimum is paid. And I would set that up on an auto payment. So when you have a credit card, you can go in and adjust your payments. Be sure that you have it set up that it auto pays at least the minimum amount. Apologize. I see I have a question. Is it true that if I paid the credit card on the due date, I'm already late? I think that you can pay right up into the due date. So it needs to be on that date. So you can call, and as long as you get it in on that date, it should be good. I would set up, whenever you have a credit card account, I would look and see what that payment day it is. And I would put that in my phone, a reminder, like maybe 5 days before, so you can check all the charges on your credit card. And then to be sure that you get it paid before that date. I would set it to pay 1 day before. And then credit inquiries. Every time you apply for some new form of credit, whether it be a credit card, mortgage, or a hard inquiry is made. The hard inquiry is reported on your credit report, and it stays there for 24 months, but will only be able to affect your score for the first 12 months. Higher scores, the ones with the 800, FICO score, have low utilization. That means credit utilization is the percentage of credit limit or the loan which is being used. So they might have credit extended to them of like 20,000, but they're only using 7% of that. So this applies to installment loans for the high achievers. An average of 35% has been paid down. I hope this has given you a lot of tips and information on how to manage credit and debt, and know that you have brains in your head. This, to quote Dr. Seuss, it's Fort Worth Public Library. You have brains in your head, you have feet in your shoes. You can steer yourself in any direction you choose. So I'm hoping that now that you know that 35% of your credit score has to do with timely payments, be sure and set your credit cards up so that it pays the minimum payment monthly. Right there, that would help the most with your credit score. And with knowledge comes power. That's why we're doing this lunch and learn, and that's why you're here today. And I hope that I've given you things to think about so that you can play the game of managing your FICO score and get your credit rates up. I've seen it happen before. People do that a lot, and it's just knowing the game. I've had some clients that thought that the best option was to not have any credit cards. But then they went to rent a car and they couldn't even rent a car. And then when they went to get a loan, they didn't have a FICO score. So even with your kids that are going off to college, it's good to establish FICO and credit for them, because when they start applying for jobs, the credit card companies are the employers are gonna look and see what's a FICO score. I know it seems backwards, but that's what it is. The last thing that I wanted to offer is you can email me. I have an article all about credit scores. It kind of covers a lot of the topics we talked about today. So if you want something hard that you can have at home and kind of go over the things that we've covered today, you can email me at jan@vwmplanning.com and ask for the All About Credit Scores white paper, and I'll be happy to send it to you. So it looks like we have another question here, Jennifer. Also, the information on the soft and hard inquiries into your credit history. Oh, okay. Thank you for the information about the part of keeping it paid accounts active. Yes. A lot of people are not aware of that. And even me today, I have so many credit cards that I'd had to open. For example, sometimes you open up a credit card to a hot water heater, for example. We had to get a hot water heater. They were offering 0% financing. Well, that's a credit card, Synchrony Bank. And so I've kept that open, and then I'll take it out from time to time and do like a $10 charge and then put it back in the file. So keep all those old credit cards open, keep them handy, keep them safe so that nobody can get to it. And you don't want credit closed on you, because that actually is part of the calculation too. At the end of our presentation, that went 30 minutes, so I'm open to any more questions that you have, or if you want me to go back to a particular slide, Jennifer, you can let me know.
Yep. So if anybody has any additional questions, post them in the chat. I think it's interesting that you talked about your water heater and it ended up being a credit card. I actually had to replace my air conditioning unit last year, and that's like $20,000. Not quite that much, but it was between like 10 and 15, I think. And so they financed that. But in my case, it's a secured loan.
Okay.
It's not a credit card. So it's interesting how it's not always, it varies, right? From company to company. So something to think about when you're, even though when you're in that situation, you need to resolve it right away.
I think you're right, because actually we replaced our air conditioner earlier this year, and same thing. We'll finance it for free for 24 months. I think that using credit is a tool. And you have to be aware, and you just don't want to take out a lot of credit, but we wanted to take advantage of their 2 years no interest financing. But again, when they sent me the paperwork and I said yes, of course I didn't ask, is it a revolving or a secured? But again, it was synchrony. It was the same that we use
Interesting.
the hot water heater. So, and sure enough, like that next month, I saw my FICO score because I monitor mine monthly. It comes on my Discover bill. It's actually on my Citibank card. But I saw it dip, and it's because I added credit to, they're looking at the overall what you have extended. So
Yes.
great point, Jennifer, and good point for people to be aware of. And not to feel bad about using it. I mean, I have some people that are just like, oh no, I don't want to have a credit card. I don't want to have any kind of debt. And I'm like, well, if they're offering 0%, I'd rather do that and use their credit, and know that I'm going to pay it off.
Right. All right. So we have a question in the chat. Would you recommend to calling a creditor to ask for an increase on your credit limit if you're close to your 30%?
You can, Maria, you can call and negotiate with them and ask them to raise your credit limit. And also, you can also talk to them about lowering the rate. A lot of credit card companies that, some of my cards that I don't use anymore, of course, they have to send out the Privacy Act. But I've noticed they've been sending out, and some of the credit card rates now are in the 28 to 30%. And I've worked on it over the years, but I have a really good FICO score. And I was like, that's ridiculous. And I pay it off monthly. I'm at a point where I can do that now. But you can call them and negotiate. So yes, Maria, I would call and see what the options are. And because when you first get your credit card, it might be a card that you got a long time ago, and they give you a lower limit. So it might be 2,500. Well, now with your credit history and your work history, then they might raise it to 50,000, to 5,000 or 10,000. And that's going to help with your utilization that we talked about.
And you recommended monitoring your credit score and making sure you look at your credit report once a year. I also suggest you do that because you're also looking for fraudulent accounts too, right? So
Yes.
a lot of people don't think about that, but you also want to make sure that what's actually on your credit report is your stuff.
I 100% agree. And if you've ever ordered the 3 different reports, they're all different and they contain different information. And once you go through that, if you see a discrepancy, either in an address or a name, then the best thing is to write to them and keep on it and get that corrected. And I'll say that I'm going to add this. It wasn't in my slide, but I've had a lot of clients calling me, and then I actually just got the letter on my kids this weekend. There was a big transfer of data called the Move It. It just happened this year. So with insurance companies, my son, it was from the HR company, but there's been a big data breach this year, and it's called the Move It data breach. And I've had a lot of clients calling me about it, and then my son got a letter. And because of this breach, these companies are offering free credit monitoring, and they give you a link. There's usually a master code, and you can go online. I highly recommend that. I do that every time that there's a data breach, because they'll monitor, and they'll send you like a monthly, you can get it via text. That's what I do, on if there's been any inquiries into your account, or if your FICO score, if a score has changed. So if you've been involved in this Move It breach, which is huge, I've had so many people contact me on it, they'll probably offer you free credit monitoring, and I would say do it. You can sign up for credit monitoring like LifeLock and other, IDX, but you pay a monthly fee. And I don't think that that's bad either, but you might be able to get it for free.
All right. Okay. Another question. Do you recommend a freeze on your credit and why? Because I've heard that it's difficult to remove the freeze on all three credit agencies once you do it.
It is. It depends on what has happened in your life. And so this is something that happened to me in 97. I was about to buy my first home. I was living in a condo that had the mail slots where you go and do the little key, so it's a multiple. And literally a week before I was going to go to closing, I had money in my savings account ready to go, and somebody had accessed that. Somebody had opened up a credit card in my name, and all that I can think of is that they had got access to the mailbox. So it was all rectified, but I went ahead and put a freeze on my credit. What happened going forward was and everything was taken care of. Those credit cards were closed. I got the money back into my checking. I was able to close and buy the house, but it was a very scary time. To me, that warranted putting a freeze on my credit. But going forward, if I went to Best Buy like a year later and I wanted to buy a new TV, for my house and get their 0% interest, I would have to lift that freeze for them to do an inquiry so that I could get their free financing. So it is a little bit of a hassle. I wouldn't say put a freeze on just for the heck of being extra safe. But if all of a sudden you're traveling and all your purse has been stolen, all your credit cards were in there, and you can't, get to that in time, I would consider a freeze. And it is a little bit of a hassle, but you can work around that. It's just a matter of contacting them and lifting the freeze. Good questions.
All right. Any other questions? Okay. So we want to thank Jan for joining us today. I hope you got some good information. Tomorrow, you'll receive an email from us via Zoom with a link to a quick survey. The information that you provide on the survey helps us plan for future presentations. It's just about 6 questions, so we'd love for you to fill that out. Our next financial planning presentation will be in December. You'll find more information about it on our website, fortworthlibrary.org. And if you want to review or share the information from today, we did record this presentation and it will be posted on our YouTube page in the next couple of weeks. We'd love for you to subscribe to our channel and turn on those notifications to find out more stuff that's going on at the library. So thank you again, Jan. Thanks to everyone else. Have a great day.
Thank you. Have a good day.